Hey everyone, this is Ryan Mallory for SharePlanner.com. Today's June 30th, 2016. Coming at you here with a market that has consumed a truckload of meth and crack. And if you look at the price action since last Friday, you would be hard-pressed to argue otherwise. Following the Brexit, we go from 2130 down, or 2113 on the S&P 500 at Thursday's close. We gap down, hundreds and hundreds of points on the Dow. We come all the way down Monday afternoon and hit the lows of 1991 on the S&P. I mean, that's a huge drop. That take offhand, that's like a 122-point drop. And then from there, we go and rally 102 points so far in the last 3 days. So a lot of stuff is happening right here. And for instance, today you have the European Central Bank saying, "Oh, we'll cut interest rates even further," and that's what the market's hung up on right now. It's not hung up on, are we going to have good earnings? Is Apple producing? Is Google have prospects for strong future growth? Are we going to continue to see the market continue to rise? That's not the questions that the market's asking itself right now. Instead, what the market's asking itself is what's the European Central Bank doing for me? What's the People's Bank of China going to do for me? What is the Bank of Japan going to do for me? And what is Janet Yellen going to say? And what is Bullard going to say? And all these things are cascading into this market that is just begging for some relief, begging for a pullback. And because you have central banks so freaked out by any prospect of a decline in the market really ultimately doesn't really go anywhere. Look at the S&P 500 from the past 2 years. Okay, we're trading at 2092, and people think, "Oh yeah, the market's coming back and everything." The market hasn't gone anywhere. It really hasn't. I mean, look at where it's at. What has happened over the last 2 years? It's gone nowhere. The only thing that you can do is buy up here, or I'm sorry, no, that's what a lot of people are doing. They're buying up here, but no, the only thing you can do is sell up here, buy down here. Okay, that's all you can do. Sell up here, buy back down here. Sell up here, buy back down here. That is all you can do. That's what the market is. That's the trading environment we are currently stuck in. Look at the 200-day moving average. This is a flatline 200-day moving average because the market is ultimately not going anywhere. And every time we get up to 2100, what happens? We sell off every freaking time. You look at it here. Back in early June, we sold off. Look at Brexit, up above 2100, we sold off. You go back into November of last year, rate hikes and everything else started coming into the picture, we sold off. January, we almost got up to 2100 before we sold off. You look at the May highs of 2134, I believe is what it was reached. We sold off, not all at once, but ultimately in August, we sold off. That is the story with this market. It isn't going anywhere because it keeps getting artificially propped up by the central banks across the world to keep it from going back down. And of course, you have some other things too. And these are natural things. These are okay, but it is an obsession of companies right now to buy back their company stock. What's the long-term ramifications of that? I don't know. I mean, you got JP Morgan, Bank of America, Citigroup, Goldman Sachs. They love buying back their stock apparently. And there's lots of other companies besides the banking stocks that are doing it. Those are just the ones that come to mind right off the bat. But that's helping it too, because you're keeping you're basically killing the supply of the stock while not changing the demand, which basically is like increasing the demand for a smaller amount of quantity of shares. So that is really the market in a nutshell. You look at QQQ, and I did a post on this earlier today. I mean, it's even worse. I mean, look at this thing. This is going nowhere. This is 2 years of absolutely nothing. So it's still tradable. You can still make money, but you got to be able to trade in this range. And the crazy thing is it's not like we're steadily going up to the top end of the range, steadily coming down down to the bottom of the range. It is violent whiplash type movements where in the last 3 days the S&P's rallied over 100 points, and the 2 days prior to that the S&P had dropped 122 points. That is violent behavior, and And I had tweeted out, not too long ago that, it used to be where you had these like, rounded U-shaped bottoms. Then we go to like these double bottom type bottoms. Then we have V-shaped bottoms, and that's been the rage for the last couple of years. You just bounce right off. You look at the bounce from the last 2-3 days, you have literally got on your hands now like an I-shaped bounce. Like it just goes straight up, straight down. Like there's no breather in between. There's no like angle, no trajectory. It's straight down, straight up. I mean, as fast as it goes down, it goes right back up. And that's not good for the market. I mean, look at the Russell, same thing. And really the Russell is one of the few indices that it's actually had some kind of direction over the past couple of years. I mean, we reached a high at like almost 1,300 on the Russell, and it sold off all the way down to 950, and it's been rebounding slowly but surely. But that's one of the true last few areas where there's actually been a trend involved. So yeah, trend following is not the easiest thing in the world right now. You got to play the extremes, play the bounces, play when the markets get too overdone. And you can see right now S&P heading into the close is still trying to push. Think about it this way: at 2096, the S&P is going to be break even for the month, and we're on the last day of the trading month. How can you even fathom that after what we saw last Friday? I mean, that is completely bonkers to really wrap your mind around. But yeah, we're 3 point. Actually, we got within like a couple of decimal points or a fractional point or two, or of getting right up there to break even on the month. But we didn't quite get there. But I mean, heck, we got 10 minutes left of the trading session. Maybe it does happen. Who knows? But let's go ahead and look at gold, GLD. It's not coming off the highs. Apparently, it's not convinced that this selling's over, or else I would think that you'd see a little bit of profit taken on. But GLD is right there near its recent highs here, one of the strongest investments you could have made so far this year. You look at utilities still soaring. I mean, this is pretty strong action out of the utility sector here. You got names like FPL that's hitting over $130 a share. I call it FPL. It used to be called FPL. Now it's called NextEra Energy. And then you take a stock that I've been watching here and actually traded not too long ago, VBC. It's doing good. I mean, so the utilities are still the safe haven play is still seeing a lot of money go flowing into it. So that should be a concern as well. The VIX, it's had a nice hard bounce off of this 50-day moving average here, but more importantly, it's still hovering around this 1640 area where it seems like there's a lot of support and resistance that you can see when it's underneath it. It had a hard time getting back above it. Every time the market tried to sell off, it would just come right back and rally towards the 2100s again. This time though, we've crushed right through it, going all the way up to 27. Now it's pulling back, so you guys assume this might be some support. With 10 minutes left to go, okay, is this going to reclaim that 1640 level or not into the close? That's a good question and something worth watching. TLT still trading at its highs, so people aren't leaving these trades yet. You got the FANG stocks. Facebook is trading in the red today. Apple, it's having a nice bounce, but really it's not doing much to change its negative outlook. I mean, it still looks pretty ugly when you look at the chart of Apple. I mean, just continuously making higher or lower highs and lower highs and lower lows. Let's look at Amazon, second animal in the FANG. It's still hovering right at its recent highs. It's trading right at the 20-day moving average with support at the 50-day moving average. It hasn't done much today either. Netflix, this one's been on a nice tear for the last few days for obvious reasons, but even it's sort of petering out today. Google, one that really hasn't participated as much as you think in this rally, is actually one of the better, is the best FANG stock of the day. So your banks, they're still doing pretty good today. Bank of America, it's actually break even, but Citigroup, yeah, I mean, Goldman Sachs, you got some strength in it, but the rest of them are pretty much crap, I guess. So I don't know what to tell you. The S&P 500, it's not that I'm frustrated or anything else, but you like to see a little bit more of a market where the risk is a little bit easier to control here. That there's a lot of traps in this market, I guess is the way I would put it. It's very easy to get caught in a position where you're trying to figure out, okay, I'm going to take a big loss on this if I don't take it now. And so that's the problem that a lot of traders are focused on. I keep my risk very tight to begin with, so I don't have those questions. But for a lot of people, I mean, if you're shorting after Friday's close and you haven't covered yet, you're bleeding through the nose. I mean, basically, if you weren't shorting at the top here, you're bleeding pretty badly here. And even then, you're starting to get worried about how much more can I really take before I lose all my profits. That's the question for the Bears. The Bears are getting slaughtered. I mean, but a lot of it's self-induced. I have to ask myself, how much leverage are these people taking on when they're shorting this market? And then secondly is how fickly are these bears to where, and I can understand over the last 7 years, I mean, every dip has been, violently bought back up. Nothing like what we've seen over the last 3 days, but nonetheless, I mean, there's not a lot of mercy for the Bears. Every time there's a technical breakdown, it quickly gets bought right back up. So I can understand to a certain degree why they're quick to cover their shorts. They should be, but this is a totally different animal here, what we've seen this week. So this is the last day of the trading month. We're officially halfway done with the year. I'm up on the year as well. That's a good thing. So you can always check out my past performance on my homepage. July's rolling around. Summer months tend to be not the best time of month for year for trading. So far, that hasn't been the case. That doesn't mean there hasn't been a lot of sell-offs or anything, but the sell and may go away thing really has fallen on deaf ears so far. If you pull up the monthly chart of the S&P, you can see we're pretty much right at closing green for the month. But May was up, June is slightly down. So I mean, sell and may go away. Not quite hitting a fever pitch just yet. We'll see what July has in store for us, and we'll go for there. If you have any questions, I hope you'll feel free to send me an email, ryan@sharepointer.com. I'm always available. I'm in the chat room every day at sharepointer.com/splash zone. There you'll get all my real-time trade and swing alerts. Every trade that I put out there, I provide a stop loss, target price, where I got in at, the range to get in at, and I give you rationale and charts for all the stock trades that I do. Once again, email me, ryan@sharepointer.com if you have any questions, or just subscribe to the Splash Zone, sharepointer.com/splash zone, and you get a free 7-day trial. Check it out, see if it's for you, and learn what it means to manage risk, to be in control of your portfolio, and to consistently make profits. With that said, have a great 4th of July weekend, and God bless you all.